Hello, everybody. It's Grace Pedota from the CSE and welcoming you to our weekly Tech Tuesday virtual session. Before I introduce our moderator today, I would like to take a moment to tell you more about CSE TV on YouTube, the Canadian Securities Exchange Forum for conversations with business leaders and entrepreneurs. I will put a link to CSE TV in the chat room, which you can find to the right of your screen. I'm also putting a link to another initiative called CSE Health Tech Thursdays. This week's topic is virtual mental health. I will post a link in the chat as well for you to register. And without further ado, I would like to introduce Mark Francis.
Thank you very much, Grace, and to all of our attendees for tuning in to Tech Tuesday. Next week on the 26th, we will have 3 sessions, noon, 1 p.m. and 2 p.m., all times mountain, on a very hot space, plant proteins. These 3 sessions on the science of plant protein, trends worldwide and in Canada in plant protein and production, and the role of the food lab in developing new products will be excellent background for investors and participants in the plant protein space prior to our Thursday company presentation sessions on plant proteins with companies involved in them on February 4th, 11th, and 18th. So combined with regular company presentations on 2 Tech Tuesdays themselves, February will be a veritable virtual pub crawl for entrepreneurs and small cap investors. And in case you feel some need for some tech company presentations now, as in this month, as in this week, as per Grace's comments, check out the digital health tech companies, part of CSE's Health Tech Thursdays. We ran them last Thursday, January 14th, this coming Thursday, the 21st, and then next week on the 28th. Today, we have 2 guest panelists, Mike Weiner, partner with Dorsey in Denver, and we're having some connectivity issues. Perhaps the inauguration down south is having something to do with it. And Terry Booth, partner with RSM in Calgary. They're going to talk to us about private tech company financing instruments and how investors have to tread around and through them. And then you get me back for the Q&A. So we're switching up. We're going to start with Terry Booth, CPA and assurance partner at RSM Canada, formerly Collins Barrow, and the technology practice leader for them. Terry has been a CPA for over 30 years, including 25 years in public practice, and focuses primarily on emerging technology companies. His roles have ranged from auditor and advisor to acting as a CFO and or a board member. He has previously been a full-time and contract CFO for over 10 early-stage tech companies and was the treasurer of the Calgary Council for Advanced Technologies. He and I are also members at Valhalla Angels, and I think we have some investments in some successful tech companies, Terry, and in some unsuccessful ones together. Anyway, all yours, Terry.
Thanks, Mark, and thanks for reminding me about my unsuccessful investments. Good afternoon, everybody. Just want to do a short little talk on cap tables for tech companies and sort of why they might be a little bit different and to be honest, why they might be a little convoluted when you see them. So, and really, I think there's 3 reasons why tech companies tend to get a pretty messy cap structure as they continue to mature. And you know, sort of the main reasons behind that are, you know, tech companies generally go through multiple rounds of financing even before they get to the public markets. So I was actually talking to one of my clients today who was on a Series H financing, but they also did Series B, 2, 3, and 4. So you know, they're not even public yet, and they've been through 15 rounds of financing. And it's not unusual for tech companies to do a financing essentially every year. And that's obviously going to complicate cap structures as the companies mature and get to the point where they start to look towards the public markets. I'll talk a little bit more about valuations in a second, so let's just park that for now. And then the third reason that you're going to see some complexity in the cap tables is really around tax planning. And from a founder standpoint and from an early stage investor standpoint is, the plan with most tech companies, unlike a lot of other public companies, is, tech companies are built primarily to grow and scale quickly and to exit quickly. And so the tax planning around that tends to be more around maximizing capital gains treatment and understanding implications of that. And for that reason, sometimes you get some pretty complex tax planning that involves the founders and the employees of the company. What I really wanted to talk about most was around valuations. And valuations of tech companies is difficult and quite a bit different than what you see in other companies. So I've already mentioned sort of a couple of factors of why valuation is difficult. Is the companies are focused on growth. So top line revenue tends to be the primary criteria that people are looking at when they're assessing technology companies. And to be honest, most tech companies, as they grow, are going to take that revenue and are going to plow that back into future growth, whether that's through future development or through more marketing and distribution. The other thing that you see is tech companies tend to go to the public markets earlier than other industries. And again, that has to do a lot with their rapid growth and need for financing. So what you generally see for tech companies is that valuation is a multiple of revenue. But you'll also see that those multiples can vary widely. So in my business, I have seen deals in the last 24 months that are everywhere from 1 times revenue to 25 times revenue. So very, very large range there. So, and a lot of that is revenue recognition from an accounting standpoint can be very complex. So that makes that calculation difficult if you're looking at a multiple. But also, when you're looking especially at software as a service companies, where you see a lot of recurring revenue, those types of companies tend to be valued higher because there's the view that that recurring revenue will continue on indefinitely unless the company has a high churn rate, which is lost contracts. So depending on where the company is and their specific type of revenue is, you can have very big disagreements between management and investors, or even between investors in terms of what the value of a company should be. So what you end up seeing, and I'll talk a little bit about the structures that you see, is in a lot of cases, you will actually see companies that try to avoid the valuation discussion altogether. So what you'll see is companies that will issue safes. That stands for a simple agreement for future equity. So what that really means is that the company will take you now and will promise to issue you equity at a later date at a value that's either based on a calculated value based on the next financing, or at, in some cases we see it as a calculation based on some other metric. So what that really means is that the investor and the company haven't really come to a conclusion in terms of where they think the value of the company is, and they are saying that we're just going to price it off the next round of financing. And generally what they do is discount it to the next financing. So we generally see a discount of 10 to 15%. It is standard, but obviously there's some variation in practice. Sometimes we will see a cap on what that valuation is. So we'll see that it'll be X% of the next financing, but it'll be capped at a pre-money valuation of, say, 5 million. And so that discount in the cap really is trying to reflect the risk that those first investors are taking when they're coming into the company early on. You will also see in a lot of companies, you'll see convertible debentures, very similar to a SAFE. The only difference is that the convertible debenture actually has some debt features. So, there is the possibility that the company could repay that convertible debenture, and they may get paid an interest rate. But what you can also see on convertible debentures is that those debentures can get converted into common shares, even at a set amount, or they can be priced off of future financing. So what you're seeing is that you're seeing these multiple financings that are happening, and the calculation continues to get complex each time you have another financing. What you tend to see as the company matures is that you start to get these, especially when the venture capital firms get involved, is you start to see different preferences for each successive investor. So that's typically done through preferred shares, where a specific class of preferred share will have a preference over all of the other shares in the company. And so what tends to happen as you have companies that go through multiple rounds is that each successive round, the investors in that round want to have a preference over the earlier stage investors. So they'll include in the terms of their preferred shares that they get paid first at a set amount, but then they share on the overall upside to the entities. So what ends up happening is, as you have these companies that go through their B, C, D, and E rounds, is those waterfall calculations become extremely complex. And then when you're starting to look at, how do we go to the public markets, or how do we even go towards an exit, is that calculation and those negotiations with all of the investors in each of those instruments becomes very difficult, and at times can really handcuff the company going forward if the terms of the preference are overly punitive to the early stage investors. And you can definitely see that, and what you can see in a lot of cases, if the company isn't doing well and you see a bit of a down round, that causes significant problems with the very early stage investors, because the way the waterfall works is all of the value is now sitting in those preferred shares that were later on. So I think that was all that I wanted to talk about. So Mark, I'll pass it over to you.
So Terry, let's talk about the Canadian scene, if you will, and how many times do you see these multiple exit preference shares piling up on one another? Do you see that often, or people become smarter about that and only done one or two of them recently?
Honestly, it depends on how long the company's been around. If you get companies that get up to their C, D rounds, then typically we're still seeing multiple exit preferreds. In a lot of cases, we're seeing companies go public or exit earlier. So in that case, then you're not. But to be honest, I don't think there's been a decrease in the number of them that are happening. I think the only thing that has changed it is that both public markets and the VC market, especially in the US, because there's a lot more activity there that we're not seeing companies get to those later stages of funding.
Right. The public markets have perhaps a way, the valuation issue and not being able to grasp the nettle and come to a resolution and kicking the can down the road has obviously longer term difficult implications. And in the public markets, of course, the way we handle that is it's all common shares, and you might have extra shares in escrow that are subject to management achieving milestones, but they're all common shares by and large, and so you get clarity on the cap table. Is there any trend among tech companies to go that route, or are they still generally working with these? Are they in the same proportion? These highly variable, highly unique and customized financial instruments.
Well, you know what? I actually think that we're seeing a trend to maybe move away from those, but I think that's been more because of the public markets being so robust, and there being more ability for those companies to go public at an earlier stage. I do think the companies are hesitating on those preferred shares that have very complex terms. I think there's been a lot of pushback on that over the last couple of years, but they are still out there. But I am seeing some companies. Even in the last year, I've seen some companies that are raising money with venture capital, and they're doing pure common stock deals. So there is a bit of a move away from them.
Well, that's good to hear. So let's talk about safe notes, in particular, are starting to, I think, fall out of favor with investors in particular, aren't they? Are there other reasons why?
I don't think, and to be honest, I don't think safe notes were ever really that popular in Canada either. Safe notes were very popular in the U.S. Going back 2-3 years ago, and a lot of that was being driven by a lot of the larger, really early stage seed funds were using safes, but we don't see that many of them in Canada, and generally what you see from an early stage investor standpoint in Canada is a preference more towards convertible debenture. I think the fact that the convertible debentures offer that ability to maybe be repaid rather than getting converted into equity, and maybe getting a bit of a coupon on that debenture, I think is a little more attractive to Canadians. We're not seeing many safes these days at all. Now, with that said, there's still some out there.
Right, and I think the other issue of a convertible debenture was that often the angels or the early stage investors would take common or safes, and then the VC would demand a debenture, and the investors who took the earliest, highest risk would end up without the security position. So if they take a convertible debenture, perhaps with some collateralization, then they at least are in a position to be in the negotiating room when the VC comes and tries to throw its weight around, right?
Yeah, and that's one thing that I think we've seen is that those early stage investors don't always think about whether that convertible debenture should be secured or not. So the vast majority of time when you're at that seed round or the angel round, we're seeing unsecured convertible debentures. And you're right, that does put you at a disadvantage when you have or a later ender that has a convertible debenture that ranks ahead of you. We see a lot of early stage investors that do not secure their debentures, and that does create a disadvantage when those later investors come in with secured convertibles.
Right. So let's talk about the strategy and tactics. The company decides it's going to go public and it has these instruments outstanding, in particular a multiple exit preferred. What negotiating strategies can be used to get everyone to come to the table? Because obviously if everyone doesn't come to the table, it's pretty hard to move the company forward into the public markets. So have you seen any particular strategies that can help the company or the corporate finance people and brokers who are trying to push this forward?
Yeah, honestly, Mark, I think the only thing that we've seen is that those negotiations can quite often be very difficult. And, my only suggestion is to start those negotiations as early as you possibly can. what you are going to see, especially if it is at a valuation that is maybe lower than people thought it was, is that there is essentially a free-for-all amongst the investors on sort of capturing the value that they brought to the table. And generally what you see is the last investor in are really in a strong position because they've got that last preference. But at the same time, they still do need the approval of the common shareholders and the other investors to move forward. So it really is that it's a negotiation where you are trying to make sure that you are taking everybody's interests into account and recognizing sort of who was in when and what the risk is that everybody had. Now, with that said, it's highly unlikely that you're going to make everybody happy, especially if it's a bit of a down round. But at the same time, you do need to get all the players to the table and sort of agree on where you're all going to land at the end of the day. And it generally results in sort of changes to everybody's deal, not just the last investor in.
Right. So amongst your clientele and other companies, what proportion, there's a period where very few went public. I would say in the aughts, there were very few new tech companies going public, but that started to shift. And are you seeing among the private tech company entrepreneurs a little less concern about going public and more interested as of late?
Yeah, absolutely. And I think you're right, Mark, in the last decade is that every private tech company that you talk to, their exit strategy was usually to find a strategic buyer. And now I think when we're talking to our clients and we're talking to prospective clients, I'd say it's a pretty even mix now between the companies that think that they'll exit through a strategic buyer and companies that will exit through a going public transaction of some sort. And I think, it really helps, especially over the last year, the private capital markets have been, I call them glitchy. They haven't been smooth over the last 12 to 18 months. Whereas, the public markets have continued on and are quite strong right now. So we're seeing a lot of interest in companies that are interested in going public, whether that's in Canada or the US, because both markets are quite healthy right now for tech.
Yes, absolutely. And quite tied together, the two technology capital markets. And I think for Canadian companies, it's pretty important to get exposure down into the US as well, whether it's through US OTC markets or some method. But it's important for a Canadian tech company to get that expertise because the US has so many more sub-verticals of expertise. And, they're often the people who invest, the people who really understand the business are the ones who will invest.
Yeah, absolutely. And if you even just look at the size of the tech market and you look at, how many companies might be in one of those sub-verticals that you talked about, it's a substantial number of entities that would be in a similar space as your company. So it makes sense to go. I think you have Michael on now. So.
I think we do. Thank you, Terry. And Michael, even if we can't get your face, let's get your PowerPoint up and I can hear your voice. So let's have you present. And of course, Terry Booth, a CPA, would probably say that as a lawyer, you have horns on your head anyway, right? But that's unfair to Terry.
My mother says I have a face for radio. So
okay, well, so let's briefly introduce Michael. He's a partner in Dorsey's corporate group, the head of the corporate department at Denver, and co-head of the cannabis industry group. His practice focuses on the representation of emerging growth companies in the areas of corporate formation, mergers and acquisitions, VC and angel finance, public offerings, and securities regulation. He represents public and private companies in a variety of industries, including also biotech, renewable energy, social media, and software, in addition to the cannabis. And of course, Denver has really been, and Boulder have really been unsung technology company hubs, and you've been there for a long time. So Michael, thank you very much, and thank you for your persistence in working to log on. Sorry about that technology glitch.
I apologize that I couldn't master the technology.
No, I don't think it had to do with you. I think it had to do with something else. Anyway, so you carry on.
Great. I assume Terry's gone through his stuff. Mark, as we discussed, I do a lot of emerging company work, and one thing about startups is they're always looking to raise money, and often doing it in a non-priced round early on. In fact, I'm working on a number of those right now. What has become the most popular method for a non-priced equity investment is through a SAFE, which Terry probably talked about, a simple agreement for future equity. And that came about out of the Silicon Valley, out of Y Combinator. And the idea was to essentially do a convertible debt round, but without the debt. And essentially agree that when somebody is investing, they will invest giving a check, and that check will wait around and then convert into the first price round at some discount and maybe with a cap. The benefits of a SAFE are that you never have to pay it back. You don't have a maturity date. There is no mechanism for the investor to force anything to happen. It's just very simple. And the reason, of course, it came out of Silicon Valley is most Silicon Valley startups get funded very quickly. And therefore, the thought was there really wasn't a reason for it to hang around, and therefore we could dispense with the debt. The problem with that, as Terry may have alluded to, and I apologize if I'm duplicating effort, is that often, because it doesn't show up on your balance sheet, safe money feels like free money. And then you end up in a situation where you've raised significant amounts of money with either a conversion cap or a significant discount, and that free money is now threatening to overwhelm your round or overwhelm the pre-money valuation of your company. I recently had a situation, I'm going through one right now, where somebody raised a very small SAFE at a very low conversion cap, and as they've priced the round, that person is going to end up with 7% of the company for probably an investment that should have netted him 1 or 2%. The other concern is that if you do raise too much SAFE money with a conversion cap, that conversion cap can anchor your future rounds, meaning that why should your investor invest at a significantly higher percentage when your prior investors who invested not so long ago are significantly discounted to what has been discussed. Going on to convertible debt on slide 4. Convertible debt is sort of the old way to do things, which was during the moment where I've invested but we've not priced the round, I want to be paid back. I want to earn interest on my investment. And if things go awry and we never get funded, because there is a priority over equity in dissolution or bankruptcy, I would, as an investor, have a significant upside in the technology or the IP going forward. So that has always that has been the traditional method. Of course, from a founder standpoint and company standpoint, the concern is to actually be debt, to be for somebody to be able to say they have loaned the company money, there has to be a situation where the company or excuse me, the investors will be paid back in cash. And so if you have a year before you can, a year to price around, that can be very terrifying at the thought you might have to pay back the loan when you don't have the money. And essentially you might have to go hat in hand to try to extend the loan or get them to convert independently. The other thing that can sort of catch up with folks is the interest. You give out 10% interest, you don't think anything of it, and a year later, that 10% interest is worth some real money. If the loan extends for another year, you've doubled that up. I have a client right now, and they are just kicking themselves. They had to do a convertible debt round at a distressed point, and as they are contemplating actually doing an acquisition or being acquired, the interest is growing by the day, and it's significant. So they're really kicking themselves over that grant. And lastly, other things that can affect, or actually not lastly, third thing, things that sort of hide and you can't quite see how it may affect your cap table are liquidation preferences. Down here in the States, VCs will invest. They'll buy preferred stock. They want preferred stock because it's, of course, preferred. It's better than common. And the preferred is that they get some rights and benefits that the common stockholders don't get. And the most important is what is called the liquidation preference. Liquidation preference means that if you sell the company, the investors will either get their money back or convert to common, whichever gets them a better return. That's a simple preference and protects them from the company being sold at a low valuation. During distressed times, investors will ask for what's called participating preferred. I get my money back and then I share pro rata with the other stockholders of the company. Well, a participating preferred essentially means that although it says I might own, let's say, 40% of a company, I probably own 45% if the company is sold, because I'll get my money back first and then I'll share pro rata in the remainder. Those are really hard to track, especially because often companies will do multiple rounds of financing, and those rounds will have different preferences, which means as the sale price of the company goes up, I have to figure out at which point I'm giving somebody preference and at which point they'll convert. And as that happens, that has dramatic effects on my cap table. So until I get to a home run change of control, where everybody makes more money by converting, small changes in the valuation of the sale of the business can have a dramatic effect on my return. I'm doing one of those right now, and we just did a waterfall analysis. And of course, with my Excel skills being a little rusty, it's actually quite complicated to figure out. And they only did 2 rounds of financing. But as this potential sale price goes up, those preferences fall by the wayside, and all of a sudden, the common stockholders are getting way more money as it progresses. Those are hard things to see in the liquidation preference or in the cap table. The other thing to point out, as for early stage companies, and we're just negotiating one of these right now, U.S. VCs will typically ask for a new reserve under the stock option plan as part of the financing, and they will insist that that option plan be part of the pre-money value. So I often have founders, they go off and they start negotiating a term sheet with a VC, and they come back and say, hey, we're going to own 2/3 of the company, and the VC is going to own 1/3. And then when we actually see the term sheet, they own significantly less because the VC has insisted on a 10% option pool, and that option pool is pre-money. And so 66 goes down to 52 fairly quickly in that situation. And then, of course, the difficulty or one of the concerns there is that was great. It came out of the pre-money, but then when we actually do go to sell the company a few months later, and there's unused option pool, and that comes out of the cap table, that unused reserve benefits the investors and the founders pro rata. So it hurt one side going in, but it was across the board going out. Finally, on cap tables, just to point out, VCs the world over do not like messy cap tables, lots of equity holders with different rights. If they see a cap table with 100 stockholders, they get very nervous, worried that people might later exercise dissenters' rights or might have individual rights. It is also, if there's a lot of equity holders with different rights, it can be often difficult to determine the dilution effects of various potential change of control transactions in the future. And as I mentioned, the other thing VCs don't like is individual consent rights, and which often happens with messy cap tables. Years and years ago, we were doing a cram down financing. I was representing the VCs, and lo and behold, the former founder of the company held a consent right as a result of holding a majority of the common, and we needed one thing approved. And to add insult to injury, he was going through a divorce. And so we actually had to hire him a divorce lawyer to provide him advice that he could actually consent to the transaction, which he ultimately did. So VCs hate that. And that's one of the results of a messy cap table. And that's it for the slides.
Well, thank you, Mike. And I'm going to ask you, still have a little bit of time, and we'll ask you a couple of questions and hope to get Terry back on as well. So, Terry, you're welcome to pop back on as well. And by the way, I was spearing you, Terry, a little bit. You'll note that he always wears a very un-CPA shirt. He's always very colorful shirts. So we know that about Terry from Valhalla. Mike, Terry indicated that the trends in Canada are away from this complexity and more towards simplicity. And some of those pressures might be that the Canadian psyche tends to be a lot more about public markets. So we love straight common shares and more pressure. Are you seeing any trends in the US either toward more complexity or away from that complexity and toward more common shares?
Not towards more common shares. I have yet to see a VC accept common shares. There is certainly, though, a push amongst VCs, if they do see a complex cap table, to encourage the existing stockholders to essentially group up. So you might have a situation where a number of early stage investors will form their own seed LLC and put all their shares into that, so that we now have one stockholder with one representative to make determinations going forward, and to hold a class of equity that is part and parcel with other founders or investors. So there is a push for simplicity, but the investors are not the ones taking that bullet.
Okay, interesting. And on the multiple exit, I'm involved in a deal. I don't think Terry, I don't know if you're with me on it, but we won't mention the name. But the USVC took a multiple exit preference round. I think they have a 2x on their money back before anybody gets a dime. Yeah, I think, Terry, you are in that deal with me. I think it was 2x. It might even have been higher. Mike, do you see many where the preference is for a multiple of their investment preferential exit before anyone gets anything?
We see those really follow the economic fortunes of the company. If a company is in a distressed situation, either by dint of the economy or their own issues, you're more likely to see a multiple preference or a participating preference. When times are good, and times have been good, for the last up until March, times have been good, and actually they've been continuing, and that so we don't see those as much. I will tell you that in 2008, 2009, you saw a lot of multi-times preferences, and going back to the internet bust, you saw those as well.
Right. Terry, to put you on the spot, do you have a question for Mike? Is there something in particular?
No, actually, I was going to say, hey, we also see similar in Canada. We don't see those multiples, those 2 times, very often at all, although they tend to be in some of those investments that have been around since 2008, 2009. So I guess the one question I did have for Mike is really around safes and whether that is still a preferred vehicle in the States, given that, I think we talked when Mike was not on around, we're not seeing safes as much in Canada anymore as we would have a couple of years ago.
Safes are very popular. I would like to see them go away. But they continue to be popular. And the reason I say I'd like to see them go away is I do think, to a certain extent, folks are misusing them a little bit. And when I say misusing, I mean here in Colorado as opposed to California, where they're also very popular. In California, with all of the VCs around them, companies get either funded or not, meaning they fall apart fairly quickly. In Colorado, it can take 1 year to 2 years for even successful companies to be funded, and having a safe out there for 1 year or 2, that leads to more of the free money problem, meaning they start raising more and more off the safes rather than actually pricing the round. And if you have $1.5 million or $1 million of safes, and you are doing a priced round, it can be very difficult if there's a significant discount or a cap. Either you're going to have trouble pricing your round, or you're going to anchor your round at the amount of the cap, and that means the founders are really taking dilution in the shorts, which even the VCs and the investors don't want to see happen. If you dilute the founders too quickly, the worry is that they will lose interest in their company and they'll go on to the next one, because they've raised $3 to $5 million and they're already down at 10% ownership. That's a problem.
Yeah. So a question I asked Terry, Mike, related to going public, and do you have any, obviously that's when some difficult negotiations can start in terms of resolving, especially a multiple exit preference share. The others all convert over to common, the other instruments, but do you have any suggestions for tactics, negotiating tactics, or how that can get resolved? And often, you've got a company where the VC isn't going to come on for the next round because it's not one of their top 2 out of 20 investments, but it's, maybe the number 3, 4, or 5. It's a good quality company, but they maybe they aren't quite paying attention as much because it isn't one of their top companies. Do you have any thoughts on that?
Well, what I have found is that even if one has significant preferences, if there is a high quality IPO available, investors want to do that deal, and they may give up some or all of their preference to get into that. If you're doing a small IPO, that can be problematic, and that's where those problems can arise. But if you've gone, you have a great preference and it's exciting as an investor, you're going to double your money, and the company comes to you and says, "Hey, we have an opportunity to go public. Morgan Stanley is leading the round, or is the lead underwriter, or we're going through a SPAC, and it's going to, with a great SPAC, and let's do this." You can make even more than that. I've always found investors want to do that, even if they're giving up some preference, significant preference. An IPO as a success is so powerful, they're likely to go and do that.
Okay, very good. Well, we're now 5 minutes past our time, so I wanted to thank both of you very much, and Mike for persisting repeatedly until the system allowed you in, and we really appreciate your time. We hope U.S. Inauguration Day has gone along well, and maybe that was partly why the connectivity issues were, put on hold. Just being lighthearted about it. But Mike, yes, thank you very much for joining and persisting. Terry, thank you, and I think we're going to see you in about an hour at Valhalla when we listen to more pitches. So, definitely. Right. So, and thank you to all of you, our attendees, for participating, coming in, and come back next week for the science and future of plant proteins. This is Mark and Grace signing off for Tech Tuesdays.